Joining me now is the portfolio manager at Coolabah Capital and my Switzer Higher Yield Fund, Ying Yi Ann Cheng, and she's a portfolio manager, and it's great to see you, Ying Yi.
Thanks, Peter.
All right, so we always have a chat about where interest rates are going. We've seen this week the Reserve Bank basically sticking to its story that they don't think interest rates will rise to 2024. Along today, on Wednesday came the economic growth number, and the March quarter came in at 1.8%, bigger than was initially expected. I think 1.1% was a kind of guess some time ago. It looks like we're annualised at 7.2%. Do you think this might eventually force the Reserve Bank to move early on interest rates?
Well, firstly, I mean, the key thing is the question of whether they will taper, because in terms of moving interest rates, they're currently doing quantitative easing at the moment, which includes the purchase of government bonds. So they're essentially purchasing the debt issued by the state governments and the Commonwealth government. So before they would be actually lifting interest rates, they would need to unwind other policy stimulus that they have going on at the moment. At the moment, we have the term funding facility, which is due to end at the end of this month, so June. Meanwhile, as I said, they're already doing quantitative easing. That's purchasing the debt of the Commonwealth government and also the state governments as well. So before they look to lift interest rates, they would probably wind back on that. And so when that term funding facility, and just by the way, for your audience, the term funding facility currently allows the banks to borrow off the RBA at 0.1%. And that is not being extended, which the banks are awash with liquidity. Deposit growth is still very, very strong. And so by not extending that term funding facility, the RBA is actually de facto tapering, which means that it's not creating that sort of same degree of easing which it was doing beforehand. And if anything, our expectation is that the RBA will also continue to do QE as and when. And, we think that they continue with, rounds of QE as long as, the economy requires it, which is our base case. So in terms of interest rate hikes, I think that will be some time away, but in terms of tapering on quantitative easing, that could come in a couple of years' time, or could come in the next year. But it very much depends on, as you say, economic growth and other indicators. The key for the RBA, as we've spoken about in the past, it really all comes down to inflation and unemployment. So some of the things that we need in order to create inflation, for example, because inflation is not very high, other than the fact that we've had some rebasing effects, coming out of COVID. In order to generate core inflation, we really need also wage inflation. And that's been quite anemic. As you know, it's still circa around, under 1.5%. In order to get it back up, we need unemployment to fall, and we need unemployment to get back down towards, probably around below 4%. So somewhere around 3.5% to 4%. And so, that's its objective. And until then, I think we will continue to see stimulus via quantitative easing, i.e. government bond purchases from the RBA.
Okay, so the summary is, until probably the central bank is so worried about the strength of the economy that they start pulling QE, you're not going to start worrying about rising interest rates. Is that a fair point?
No, that's right. And if anything, look, rising interest rates, I think we are about to see, and I think we've already seen it to a certain extent, this de facto tightening or lift in interest rates already from the banks not being able to access the term funding facility at 0.1% after June. So, up until now, well, up until the end of this month, the banks can borrow off the RBA at 0.1%, and then they can, provide mortgages, for example, to households or businesses in terms of business lending. When they stop borrowing off the RBA at 0.1%, they're going to be forced to, fund at wholesale levels. And trust me, that will not be at 0.1%. Yeah. That will be, higher than that. So therefore, when they borrow at high rates in the wholesale funding market, they have to pass on that high cost of borrowing when they lend out to households and businesses.
Okay. Now, Ying Yi, because you hang out with a bunch of fun and entertaining guys and girls, who love the exciting area called the bond market, and of course you work with the most exciting person in the country, Christopher Joy, one of your debates must be around, will the inflation that's coming through be temporary or transitory, or could it be here longer than the experts are predicting? Now, when you guys, I'm sure you've had a debate on this, around the lunchroom table or whatever. What are you guys saying about this? Do you believe that inflation is going to be temporary? And how long will temporary be? And be right too.
Okay, well, look, I think inflation is definitely a concern down the track. And, as we've seen from how concerned central banks, especially people like the ECB, so the European Central Bank, are obsessed with inflation. And that's because when inflation does come, it tends to be quite sticky and could potentially be an issue. But at the moment, we're not even at that 2 to 3%, target. So when we get there, then yes, we expect inflation to hang about, and inflation could be a massive issue down the track. But right now, we're not there yet. So I think inflation is going to be potentially an issue probably in the next 3 to 10 years. But right now we need to get to that point. And I think the central bank is much more willing, given that we've undershot inflation for so long, they're willing to tolerate overshoots in inflation.
But are you saying to us that sustained inflation is probably 3 or 10 years down the track, but we might see a spike in inflation temporarily because of the getting back to normal effect? And I used an example recently. I said, well, 6 months ago, if you could buy an airline ticket to New Zealand, it was cheap as chips. But now if you try and do it, because you can go to New Zealand apart from Victorians, it's expensive because everyone wants to get it. So airlines will push the prices up. This is the normalisation process. But after 6 more months, when everyone's flying again, hopefully, well, the prices will start to stabilise and price competition will come in and the inflation rate will fall. Is that a fair call?
Yeah, so look, so you're talking about rebasing effects. Yeah, definitely.
But hang on, no one knows what you're talking about when you say rebasing. Only you and your
rebasing just means
like I got Andre laughing here.
As the economy normalises, yes, there will be temporary sort of shocks. We saw this in when we spoke last time. There was in the US, there was quite substantial numbers because they were looking at used cars, for example.
Yeah.
A lot of people want to, but again, having gone through that sort of a peak, people aren't going to be buying multiple used cars on an ongoing basis. Yeah. So we won't see that. My reference to inflation being an issue in the 3 to 10 years is actually more around the concern that because we're pumping so much stimulus and money into the system, people are going out and borrowing and purchasing. So I think it's going to be potentially, a cyclical problem down the track where it could affect, growth negatively in 3 to 10 years' time, but not right now.
All right, so let's imagine the early phases of inflation, maybe in 2 or 3 years' time. How's that going to affect your fund? Positively or negatively? Yeah,
good question. Well, it will be neutral. So if anything, there's arguably a positive effect because the fund that we do run, the Switzer Higher Yield Fund, which is one fund amongst our other portfolios at Coolabah, but the Switzer Higher Yield Fund is 100% floating. So there's no fixed rate risk in the portfolio. So imagine if you were fixed rate, which we're not. Imagine having fixed your rate, say at 1%. Let's say interest rates move higher you miss out on that move higher. You're not getting paid if interest rates are now at 1.5% or 2%, or stuck at 1% in terms of your income.
Yep.
Or the yield that you're generating as a bond investor, right? When you are a floating rate investor, or you're invested in a floating rate fund, as interest rates move high or that floating rate moves higher, you benefit from that, because if rates suddenly move from 1 to 1.5, you will get that 1.5% yield because you're floating rate.
Yeah. Okay.
And which the Switzer Higher Yield Fund would be. And then our objective on top of that is to deliver, alpha or capital gains over the top of that.
Okay, Ying Yi, as always, great to catch up. But you must promise us, when you and Chris start to worry, you'll get on the blower and we'll interview you straight away.
You will definitely hear from us.
Thanks very much.